Hey everybody, this is Rob Gantz of 𝙂𝙊𝙇𝙑𝙀. It is October 7th, 2021, and I have two very special returning guests to the program. This is going to be the all international program. From Canada, we have Nick Barisheff, who you know as the CEO of BMG Group. And we also have from Israel, Lior Gantz, the founder of Wealth Research Group. Gentlemen, how are you doing today?
Very good. Thanks for having me on again.
Sure.
Thank you, sir.
So appreciate having both of you guys on. I know it's been a little while since we've had you on the program, which is why I wanted to bring you back, because I think you each bring a unique perspective into what's going on in the world markets, as well as we're going to try to answer the question today, what's going on with gold, because it doesn't seem to be reacting to world events like it typically does. And I know each of my guests on the program has their opinion on that. I wanted to start with you, Nick. And the first question has to do with something we were talking about leading up to the recording. And that has to do with supply disruptions. On my channel a couple of days ago, I had an Economic Ninja and Steve from the Silver Chartist talking about supply disruptions going on across the world. The supply chain seems to be challenged. We've got containers sitting off the coast of Los Angeles waiting to get in. What's causing that, Nick, do you think? And what could happen specifically, say, to oil or other commodities?
Well, you've got a couple of things. You've got the supply chain disruptions, like you say, with container ships and so on, not being able to land. You've got truck drivers shortages. Like in Canada, we need 18,000 long haul truck drivers just for Canada. Mm-hmm. So there's big shortages in that respect. But then also we've got a lot of businesses simply can't find employees. So you can't produce stuff and with no employees and no transportation. So that's kind of compounding the effects as we go along. And you know, already we're seeing the rises in inflation across the board, but most particularly in terms of oil. Biden shut down the Keystone pipeline. He cut off a natural gas drilling, and now the U.S. that used to be self-sufficient before that is now dependent on foreign oil and foreign, natural gas. So as the price of oil goes up, it filters through like everything, and inflation is baked into the cake. And what I always find strange is that for gold, people tend to do the opposite of buy low and sell high. So gold is down this year to date, but when you look at all the conditions coming along in terms of the amount of money printing, the economic and social chaos being, all I can say is that it's purposely being generated, because nobody can be that incompetent. So this is all going to manifest in the next few months and get much worse. We're just getting a taste of it. So it's not a theory anymore. It's actually happening. And the question, how bad will it get? And I think it'll be pretty bad. We'll have food shortages, oil shortages, transportation shortages. And the latest thing that Biden's done was the COVID mandates. He's got thousands of nurses and doctors quitting, first responders quitting, the military, the police, all of that. When that filters through, there's going to be major chaos. It's beyond insane.
Yeah, we're having this weird labor shortage here in the US, and I would describe it as a labor shortage of currently available workers. But if you look at labor force participation rate, we've got 37% of workers who have basically given up. So it appears as though the problems with unemployment in the US are being exacerbated, and that's going to make supply chain shortages worse, and is going to affect inflation. So Lior, I wanted to turn to you. You recently wrote an article on your website, 𝙂𝙊𝙇𝙑𝙀, talking about inflation. What do you see happening with inflation going forward?
I think what what has been the theme this year is the debate between the Fed, Wall Street, and Main Street as to how to define inflation, because each of us feels inflation differently. If you're a high net worth individual, if you're a worker, if you're an official policymaker, a politician, we all have different versions of it because it touches our lives, in different areas. Obviously, the wealthy people that have a lot of their riches tied to the markets and to real estate, obviously asset inflation is in their favor, and anything that has to do with real world inflation, it doesn't make a big difference to them, because nearly everything regarding their net worth has exploded in the last year and a half. But what Wall Street care about, which is what changes the price of gold, at least on the spot price, is whether or not we have transitory inflation, and how long is this transitory inflation going to last for. Now, I think Powell set the expectations that now, meaning September, October of 2021, would be when he can no longer use this term to define what's going on. In other words, if you continue to have CPI at 4% and 5% and 6%, he cannot keep saying that this is just transitory. We had a global supply chain problem, but we don't live in a borderless world. And so what you see basically is that when you had all of this just in time supply chain around the world and you've disrupted it, now you have labor shortages in particular countries. Obviously, if the United States was allowed to bring in 50 million Chinese, they would not have a shortage of labor in the United States. The problem is that you have a world that was functioning one way and now it's functioning another way. And this transition period, which I agree with, we are in a transition period, I think is way longer than what Fed Powell is signaling. And then the second part is the fundamental error in the way that he projects it to the market. He's saying, look, we're transitioning, but we're not transitioning from world A to world B. We're transitioning through COVID. And once we're done, we will be back at the same world we had before. And that's the fundamental problem in consensus. We're not transitioning from world A back to world A. We're transitioning from one thing to a whole different thing. And that's why you see volatility in commodity prices. You see wheat going up, lumber, then natural gas in Europe, then oil, because all of these commodities are trying to figure out what is our price in this new world. I can give you an example here in Israel that construction, like large companies that are building most of the country's new housing, they're hedging commodity prices, aluminum prices, steel, etc. They're hedging 5 and 10 years ahead because they don't know what's going on. Because we've left one world where you know exactly how the supply chain works, and you're now transitioning into a different world. And I think that the best way to define this period is not transitory inflation, but discovery inflation. We're discovering right now which commodities are going to be more in demand by which countries, and we're scrambling, we're fighting over these things because we just don't know how this period will settle when capitalism, free markets, etc., really take it over. Because right now, we just don't know. And so I think in this period, it's very hard to judge inflation. And because of that, you're seeing weird scenarios in gold and silver and other commodities, while the dollar is actually up in 2021. Now, we've only had 2 years in the entire past 100 years where you had the dollar up in a calendar year, like it's up in 2021, at the same time as commodities going up over 20%. You've only had 2 years where that existed, that kind of anomaly. The last time it existed was in the year 2000. And that was the beginning of the last big super cycle for commodities. So, you know, if I look at where inflation is going forward, I think we have 4 things that we need to consider. I think it will be higher, significantly higher than in the past decade, where we've around 1.4, 1.5%. I think we're going to settle on an average of 2.4 to 2.6% for this decade, which is significantly higher. And then percentage-wise, it's 50% higher than the last decade. So it's a difference. Is it a monumental difference? Does it change a lot for the average person? It's not. It doesn't change a lot for the average person, but as an economy, as a global economy, it changes a lot, because as you know, Robert, if you steer a boat 1 degree to the side and you cross the ocean, instead of hitting Miami, you hit Colombia. So over the long term, this is a big change. But I think the things to keep in mind are, 1, how does the new supply chain work around the world? Are we going to go back to a world dominated by just in time, or are we going to see the vision of more of these think tanks that are going to that think that about 90 to 120 minutes outside of the big cities like New York, Houston, Chicago, LA, you can build big automated manufacturing hubs, and then you ship into a city from 2 hours away and not from an ocean away. Secondly, what is the role of the dollar going to be in this decade? Are we going to see a change politically? Because if you're going to see a re-rating down of the dollar, which is the trend, then that's going to impact inflation. 3, the millennials, how much their taste buds are strong for housing and just for consumer products in general. Are we basically heading into what we saw with the boomers in the 80s and 90s, where they just dominate in terms of consumption and the economy grows in real terms a lot? That's going to impact inflation. And 4th is the fact that we're starting from a point where velocity of money right now in the United States is the same level it was at the end of the Great Depression. It's the lowest it's been in recorded history for the United States. And we've just added $4 trillion to currency in circulation, not to bank reserves as you did in QE following 2008 and 9. This is not currency that just sits idly on the bank's balance sheets. This is in your neighbor's money. This is our money. So we will determine how much inflation we will see. This is a very dynamic thing, and it has to do with consumer sentiment, consumer confidence, etc. So I think there's a lot of open questions, and that is predominantly the reason that gold isn't much higher, because there's no certainty as to what is going to happen. Now, when the Fed, I'm sorry for being long, but I'm going to wrap it up. When the Fed actually raises rates for the first time and creates that certainty, now it's much easier to speculate what the price of gold should be. And I think once they start raising rates, you're going to see the price of gold bottoming and beginning to rally above 2,000 an ounce, probably towards 2,400 an ounce.
Thank you, Lior. Before we get into the gold, I want to talk a little bit more about issues that we're having and potential catalysts going forward. And Nick, he talked a lot about inflation and Fed policy. Something that we also talked about leading up to the recording was what's going on in China. It's the debt markets. It's the flip side of the monetary part of the equation. It's the debt. So China is having, a high yield or junk bond issue with Evergrande, and now Fantasia's come out in the last week as a property developer. They're having issues. So certainly problems in the real estate bond markets in China. What's your view on that in terms of, is this another Lehman moment? Is China going to be able to contain this, or what's your view?
Well, I think to really understand inflation, we should look at kind of the Austrian School of Economics in terms of inflation is always a monetary phenomenon. So the issue is, at this point, we have supply chain problems which will create price inflation that way. But we've got a much bigger set of conditions. The U.S. is looking at passing another $1.5 trillion in terms of infrastructure, and a minimum of another $3 trillion for what they call human infrastructure. But if they print that amount of money, and they probably will print some amount in between, they'll compromise on something, then that eventually will cause a decline in the purchasing power of the dollar, and then that'll get translated into price inflation. And the thing with inflation, there's various measures. The official inflation is just under 5%. But if you look at John Williams' work, Shadow Stats, I think, using old methodologies, it's already at 8-9%. And like we said, the inflation rate to a wealthy individual and someone that's making minimum wage is two different things. Mm-hmm. The food, gas, and housing become the critical things, and those things are 15 to 20% already. So your inflation could be dramatically different than someone making $1 million a year. So I think that's what's coming, and I think that as a gold investor, I would look not at what the price of gold is now, but what it's going to be. And I think so many factors are baked into the cake that the price of gold will rise dramatically, and that's where I would still stick to my $10,000 an ounce over the next few years, because the things that I based it on have gotten much worse now. So you could argue that it would go much higher than 10,000 an ounce.
And I think, Nick, you're implying that we would look at a gold adjusted to monetary aggregates or something like that, where the world realizes the issues we have with the dollar, almost like it's a capitulation on the dollar as the world reserve currency.
Yeah. I mean, the amount of money they're talking about printing with a straight face has never been done in history. Mm-hmm. And if the left-wing side of the Democratic Party has their way, it'll be far more than the $3 trillion. Bernie Sanders is talking it should be $6 trillion on top of what's already been printed. Beyond insane.
At some point, there has to be a reckoning toward, and this is a big debate. Silver Symposium now is out in Idaho about a week and a half ago. We were talking about, will gold account for all the money printed now? Plus, if you look at potential for additional spending, unfunded liabilities of Medicare, Social Security programs here in the United States, which are anywhere from 125 to 200 trillion, depending on whose accounting you believe. This certainly looks bullish for gold in the future. But is gold really the investment du jour for people? I think Lior talked about, until we get certainty with what the Fed does, we may not see gold rise a lot, because the people in the derivatives market, are hedging their bets based upon a bunch of unknowns in a transition to a new world.
There's two distinct markets. There's the paper markets, which is COMEX, let's say, and then there's the physical markets. And if you look at the physical market, which to some extent is indicative of Amazon and eBay, and these are still wide markets with a lot of people participating, but a silver coin there is already $50. Okay, not 25.
Yeah, so definitely retail
That's
physical
the
demand.
real price of gold and silver.
Yeah,
is what you see there.
So retail prices are definitely higher than what you get in the derivatives markets. Switching over to silver, I know, Lior, you recently wrote about silver and how it's underpriced to equities. What do you see for silver going forward?
I think silver has become very much decoupled from gold. So to talk about the gold-silver ratio and to harp on that historic 16 to 1 or 12 to 1 or whatever measure you're going based off of is not proper thinking. Under Trump, we've reached an all-time high for the gold-silver ratio at 123-1. And I think in June, with what happened with gold becoming a tier 1 asset, it's a different beast. Gold is the world's most liquid asset class right now. The price discovery on it is nearly perfect. So whether or not somebody predicts that it will be higher in the future, et cetera, or lower in the future, there are so many participants in that market and so much information available on that market that the price of gold cannot be fundamentally mistaken by as much as silver can. So if you're looking for a speculative precious metal where the difference between what it could be worth and what the market believes it's worth is great, it would be silver, not gold. Gold, it may be off by a few percentage points here and there, but you're talking about an investment class that central banks, governments, funds, it's a very large and very sophisticated investment class. And I think that with silver, that's where you can see much more of a discovery of what the real price is than with gold. With that said, here's what I think could change the way that people view silver going forward. For one, the DXY, which is a very important measure for the strength of the dollar, is above 90. 90 being the support, for dollars between now and 2014. This is a 7-year support. So once it breaches below 90, I think this dramatically changes the situation for silver. That's one thing to look at. For right now, to go heavy on silver, because you build this script in your mind that silver should be 50 if gold is 1800, whatever you're whatever the narrative you're selling yourself, it doesn't hold up if you look at what really throughout history dictates the price of silver more than anything, which is either dollar strength or weakness. So I think that's one thing to keep in mind. The dollar is not weak enough to justify a huge rally for the paper price of silver. I do agree with Nick that there's two different markets here. Obviously, the people that buy physical silver and the people that buy paper silver are totally different people or institutions. So that's one thing to keep in mind. Look at 90, keep tracking the DXY on a daily basis. And when it breaches below that, there's so many algorithms that are programmed to short the dollar. If it reaches 90 or 89 or 88, it becomes a very hard process for the dollar to go back above 90 if it breaches significantly below. I think we will enter actually a bear market for the dollar once we hit 90 or below, a multi-year bear market. So I think there's a big catalyst for silver ahead of us if the dollar actually dips below 90. Second thing is, I think the range for silver on a technical basis goes between 22.5 and 29.5, a $7 range where it goes between the resistance and the support. Right now, it's literally fighting its support. If it can stay above 22.5 and start to go back up, this will be a very strong indication that there's enough buyers for silver so that it doesn't collapse towards below 20 and worse, and enters basically a bear market again. With all the other basket of commodities going up substantially this year, and with oil being one of the, if not the most important commodity for plotting the price of silver. If you plot oil and silver for the past 50 years, you see almost a 90% correlation. So with oil reaching these multi-year highs right now, I think there's many things that show us that silver is trending higher rather than lower. Now, I think what can really be important here is if we see something to the effect of what we saw in January, where you have a lot of new investors, millennials, looking at silver and understanding how it is very important as an asset class. Now, silver is such a small market that if in the millennial generation, 75 million in the United States and well above that around the world, if a given percentage of them buy just 1 or 2 or 3 ounces of silver, the market for silver will completely change in terms of the demand. It will just completely change and create a re-rating of what an ounce of silver is worth. Now, the argument that silver is already fully priced, etc., has to do with its being quasi a industrial metal. Because of that, a lot of people argue, look, Apple and these tech giants that need it for their iPhones and laptops and the solar panels, etc., they won't allow the price of silver to go to 40 or 50, etc. Well, the amount of silver used in all of these industrial products is such a microdose that it doesn't even change the end price. The price of the consumer will not change if silver goes to 40 an ounce. It doesn't change the price of the iPhone. It doesn't create that much inflation within industrial products, the thousands and thousands of industrial products that silver goes into. So that argument does not hold water. Silver can be $50 an ounce, and still, for most of the items that it goes into, it will not be passed on to the consumer. So I think you need to keep to keep an eye on that as well. As a trader, I like silver more than I like gold. As a long-term investor, I think the last 50 years have proven that under the fiat monetary system, gold compounds at a 6.7% clip over the last 50 years, and obviously over the last 21 years at much higher rates. And silver is about half of that. It doesn't do as well under the fiat monetary system, but as a rally, or when you want to buy low and sell higher later, a trade, and not in long-term accumulation of the physical as an insurance, I think silver is preferable specifically now.
Nick, last thoughts before we wrap up. What else did you want to share with the audience today?
Well, to add on to the silver thing, the issue is that gold is primarily a monetary asset, and there's 33,000 tons of above ground gold that can be drawn down from. Silver is not the case. It's currently primarily an industrial commodity. And as an industrial commodity, it is both supply and demand inelastic. If the silver price went to 200 today, you couldn't increase production because 80% of silver production is byproduct. Mm-hmm. So you're not going to, dig up tons of copper or zinc because the price of silver is 200. And like you were saying, is the industrial usage in terms of the electronics, it's a minuscule percentage, but without it, you don't build any iPhones. So if you're an iPhone builder, then at one time you're going to wake up and say, look, we need to buy a ton of silver. The way it happened with Ford buying palladium in 1998. In 98, they bought $5 billion of palladium because they weren't going to build cars without it. Mm-hmm. And the same applies here. So the risk to the manufacturer isn't the price. They could care less about the price. But if there's no supply, they don't make whatever it is they're making at all. There's no substitute that's economically viable.
Great point.
That can have a huge impact on price. And to look at that is the rare earth metals, the iridiums, rhodiums, and so on. Silver can act as one of those. And those are pure industrial supply demand issues.
Lior, last thoughts for the audience before we wrap up.
I think that's a great point to keep in mind, that because we just don't know the new world of supply chains. Somebody can wake up, a CEO can wake up and tell his board, I am not going to tolerate having a questionable silver source, and that can create some sort of a crunch where a lot of these CEOs will want to hedge a few years ahead and be willing to pay a premium. That's a very good point.
Nick, Lior, thank you so much for joining the program. I'm glad to have you both back on.
My pleasure. Have a good weekend.
Thank you. Hey guys, remember to like, subscribe, and hit that notification bell for updates. Also come to the website 𝙂𝙊𝙇𝙬𝙊𝙎.com and sign up for a free newsletter. We'll be attending the New Orleans Investment Conference October 19th through 22nd, where we'll be holding a very special private investor event. This is going to be invite only. We'll provide a sign-up link in the coming days. Stay tuned to the channel for more information, and save the date, 19th through 22nd in New Orleans.